Hey, what's up, guys? Welcome to the Holy Macro Show. We are in action today. This week has been crazy. I wanted to do an actual live this week. I had an interview set up. Couldn't do that. Just kind of was in a mess this week. Anybody who's in the Midwest, shout out to you. We get hit with random things from time to time. It's always funny, Kashop, because the weather here is like I think it's like a U.S. phenomenon that we get so many tornadoes, and everywhere in the world really doesn't get tornadoes. Is that a thing? Have you ever seen a tornado?
Well, I haven't seen a tornado, but I have seen these high-speed winds, and we used to call them rainstorms. Uproot some of the trees, maybe shatter a few windows like that. But I mean, nothing like a tornado. I mean, I've seen it only in the movies, not in real life. And looking out my window here, it's just crazy. Like, if there's a tornado in Dubai, all that separates me from it is one thin sheet of glass. That's it.
Yeah, I mean here
Yeah.
it's like that every house is kind of built with the idea that you get hit by something. The weather in Ohio, I know Freely's out in this type of area as well. You're north of me, but everywhere like Ohio, Michigan, Indiana, Illinois, any Kansas, all the way to Kansas, and everything in the Midwest is just like subject to tornadoes, random monsoon type of weather. Sometimes it'll snow. It'll be like, damn near summer. Sometimes it'll be 80 degrees in the winter. We have the weirdest weather here. We always have, though. Like, it's not something that's really changed. But I've seen plenty of tornadoes. I have a lot of funny tornado stories. I won't dig into that, but there's a funny law that I'll bring up real fast. I want to say it's Iowa. We were doing events in Iowa at some point many years ago, and I'm driving through with the guys, and I am in the truck and trailer, and all of a sudden we see this huge tornado, like literally in the middle of a field. Like we can see it it's probably like 1,000 feet away, and we're like, fuck, I don't know what to do here. So we pull over. We're like, okay, well, let's at least get shelter. So we like try to go into a gas station. The doors are locked, but there's people inside of it, and we're like, what the fuck is going on? We go over to a Taco Bell. Doors are like tells us, they're like, hey, when there's a tornado, there's a law that everybody has to stay inside, and we lock all the doors and stuff. And I was like, so anybody outside with the tornado is just subject to die at this point. And they're like, I don't know what to tell you. So I'm like, I don't know what to do. So we just start driving. So I'm like, well, let's try to outrun it, because I'm an idiot. And I'm like, maybe I'll outrun a tornado, which doesn't make any sense. So we start driving on the highway. It starts coming, it like turns and starts coming our direction. Now, I don't know shit about tornadoes. I didn't know they just turn, but they just turn and it starts coming our direction. And there's a cop on the highway that's just standing in the middle of the highway waving at us. He waves us under this underpass, and we just sit there and kind of wait it out, and it goes right over us. So it's like, it was just, I've seen some real crazy ones here, but this one hit my house. I've never it was definitely interesting. So we'll see how it goes. I'm on a Starlink right now, so people let me know if this starts to sound funny or looks bad or anything. But so far, so good. I think everything's fine. But so Kashop, we got a lot to get through today. I am gonna hop off a little bit early today. So let's start jumping into it. So
Yeah.
first off, we got the 30-year. This just cracked me up. So the 30-year yield is just ripping higher. And this is funny because this is about the Fed chair. And he's like, you got this. I mean, this is just, I don't know who made this, but thank God you made it. I absolutely adore you. I think you're fucking hilarious. This is great. So, Kashab, tell me a little bit about what you think about the new Fed chair. What's your read on this guy? Because I'm really curious about that more than anything. Because I have a lot of thoughts, but I'm not sure what to make of it just yet.
I think he's all talk, no action. And that's pretty much what we have seen in the meetings as well. Like, it's like, hey, we really care about inflation. We are going to hit our 2% target. We are not changing our target, blah, blah, blah. And then people ask, so what are you going to do about it? Well, we sit around and talk. But we don't just talk, we have a good old fashioned family fight about it. And that's it. And I'm like, so it's basically just all talk, but you have a little bit of back and forth with people who disagree with you. Is that it? And he's like, well, yes. And that's pretty much all they have done. And then the hilarious part is when someone asks him, are you going to raise rates? He's like, no, the market is going to raise it for us. And that's pretty much why this is funny. And it's like, yeah, the market's going to raise rates across the curve, but you're the one who controls the short end. So shouldn't you be raising it there if you really care about inflation? And they're like, nah, not really. We're not going to do that. And that is just like a lot of, however, the interviewers ask these questions, he just punts it like he just doesn't want to answer it. Like admitting that the Fed does not care about inflation is kind of like a death sentence for the Fed because then all the money printer Gobir memes will start coming back. But admitting that they have moved the goalpost and saying that it's no longer 2%, it's 3% means everyone's going to think, okay, in reality it's going to be 4% now. So and then those expectations will adjust all along the curve. So they're kind of just trying to hope that, uh, like in the movies, like in a very badly made movie, when you see the ending would be just a complete non sequitur. It's called a Deus ex machina kind of ending where something just comes in and saves the day and something that's not even in the script. And I think that's pretty much what the Fed is hoping for right now. They just want something to come along and cause some deflation so that they are like, hey, our mission is accomplished and good. We did not have to raise rates or meet Trump's hire for that. So that's kind of the path they are heading on, and Wash specifically. And it's not just Wash. So one of the other governors, Barr, he came out and said that money printing is good. Like, I mean, it was something completely ridiculous. I have a whole post on it where he came out and said that the Fed should not be shrinking its balance sheet, it should be expanding it because shrinking the balance sheet is not going to be good for the economy. And his reasoning was all backwards. He's like, the banks want to create money. And when the banks create money, that means they have more in their reserves with the Fed. And because they have more in reserves with the Fed, we need to print more money to offset those reserves. And I was like, that basically just means, instead of controlling the banks, you're telling them, hey, go forth and print as much as you want, and we will print more to back you up. It's like the absolute opposite of what a central bank needs to do. It's like they are completely given over their function. And I mean, we all know that the Fed has been captured, but it is now so blatantly obvious to the whole world that I really don't see how this survives for another 10 years. And I really don't see how people don't wake up and start stockpiling gold, which is what China has been doing. And I think that's something everyone's going to do. I mean, once at least once this bull market really starts to get attention, and for that we need to see this AI bubble just get destroyed. And I think once that happens, a lot of things will reset.
No, I agree. I think we're in this part of the cycle where it's like they're really, really getting over their skis here. And this to me is always funny, which is so this is what we mean here. Like when we're talking about like this is getting fucking out of control, this is getting fucking out of control. Like this is something they're literally just letting go. And if you look at you this week, the CPI report came out, guys, and granted there was just zero inflation, it's only at 3.4%, everything's great, like we don't have to raise rates. I mean, that's literally what the market's saying. So the Fed rate probabilities dropped. They don't want to, everybody was worried about a rate hike in September. I was like, I don't think they're going to do one unless they're like literally forced to. If you go to the gas station and gas prices are $5.50 or $6, at that point they'll be like, okay, we're gonna raise rates a little bit here and there. But until that point, they're not doing shit. They're just going to continue to do the same thing that we're seeing already, which is, hey, let's just let it go. Hey, the 30 years creating its own rate hikes. It's funny. People believe that. Like that's the thing that blows my fucking mind is that people keep coming to me and being like, hey, we are getting rate hikes through the 30 year. And I'm like, yes, you and I are getting rate hikes. The banks are not getting a rate hike. They're getting a rate cut basically. So as they're making more money because the 30 year keeps going spread. This is why this spread is important. This is something that and build. I don't know if that cut out. Did that cut out for you, Kashop, or is that just me?
Yeah, you did cut off for a bit, but it's
Okay,
fine.
so
We
I'm
can follow you. Yeah.
I'm back. I don't know what the hell's going on. Anyway, so this spread continues to widen. And as the spread continues to widen here, we're just seeing this setup that the banks are basically borrowing from the short end of the curve. We get money from the long end of the curve when we borrow money from the banks. And as that continues, we see more liquidity out there in the market. And that liquidity, when this spread gets that wide, usually goes towards inflationary assets. I mean, it's very simple to understand this. And once you understand it, you can basically kind of figure out where you want to go going forward. So, Kashop, the dollar, obviously the most important piece that we're always looking at. What do you think about the dollar? You think the dollar's days are numbered here? Do you think the dollar's moving back up? How do you think that portrays with the rest of what the world's doing? Europe, their central banks compared to the U.S. central banks.
So I think the US is going to be hit by a trifecta, which is weaker dollar, weaker bonds, weaker stocks. And that's a scenario almost no one is prepared for. Now, why would something like that happen? Let's start with weaker stocks. And the reason for weaker stocks is you have all these studies which say, going back to 1950 or 1910 or whatever, the S&P has always gone up. And you have all these ridiculous studies which, it just gets more bizarre by the day. It's like if the stock market goes up 5% over a period of 10 days, it means it's going to go up 50% over a period of 6 months. Like studies like this, which have basically two data points picked over 70, 80 years, and they're like, look, this is the proof, this is the statistical proof. And what it's actually hiding is the remarkable amount of concentration risk. Like this is worse than the dot-com bubble. This is worse than any bubble since probably the railroads. And in the railroads bubble, how many people even own stocks? Not many. And now you have Trump accounts, and your newborn baby has a stock account now. It's like the cult of equities has come full circle from the death of equities in 1979 to now everyone must own stocks. And you look at the data from Charles Schwab, Robinhood, Interactive Brokers, all these big brokerage firms, you see month on month growth in brokerage accounts, month on month growth in funded balances, month on month growth in margin loans. And it just, because I'm a student of history, it reminds me a lot of China. And 2014 in China, the number of brokerage accounts opening, it just went vertical. And 2015, the market peaked, and then for almost a decade, it was dead money. In fact, worse than dead money because almost everyone lost it all. Everyone who was invested lost it all. And that's also because of the policy changes that came about in response to the crash. Now, I see something very similar happening in the US. So, firstly, we have this massive AI bubble. Now, let's put this in perspective. The AI spending is on the order of just in the last 2 to 3 years, and maybe going forward for the next 1 or 2 years, the amount of spending that's happening on these data centers and GPUs and stuff is something on the order of $2 to $3 trillion. That's trillion with a T. And OpenAI and Anthropic, the two big AI giants today in the US, so they have hit a revenue run rate of $40 billion per year. Now, revenue run rate means they haven't exactly made 40 billion. It just means that, say they have $3 billion in subscriptions coming in this month, then they do an into 12 and they say that it's going to be $36 billion over the next 12 months. So that is pretty much what that metric is. So you have something like these big AI giants clocking in $7 billion in monthly revenue after the AI bubble has been around since what, November 2022 is when it started with the launch of ChatGPT. So it has been more than 3.5 years, and it is only now that they are hitting a few billion in monthly revenue. And against this, they have spent close to $2 to $3 trillion on capex. Now, the math just doesn't work out. Like here, you have let's just be charitable and say they hit $80 billion in revenue in a year, and that has to support $2 trillion in capex. Now, Just to get a 10% return on that capex, you need 200 billion versus your 80. And that's assuming there are no other costs, which of course we know is not true. Now, considering that these chips depreciate in something like 3 to 4 years, you're looking at something like 600, $700 billion in revenue just to service what has been spent and what has been committed so far. And we are nowhere close to that. So this bubble is probably more massive than the railroads. And once it goes bust, it's going to drag down the S&P. And the reason is the concentration risk in the S&P 500 index and all the other index products that are around that. Like we saw this with South Korea, where you had a crazy up move and then a crazy down move just because of the leverage. And I think we're going to see the same thing in the stock market. No, the bond market, we have been going on about it all the time. And it's like, I think we are going to get to something like $5 trillion a year in the federal deficit. So that's obviously not sustainable, especially when you look at China selling, Japan selling. Almost everyone is getting out of treasuries because everyone remembers what happened in 2022 when rates rose and their portfolios got decimated. So just last
Let's
year, we
stop
had
there for
this.
1 sec, Kashap. Let's stop there for
Yeah.
1 second. Let's explain to people, why don't you explain, inflation and the debt? Because this is the thing that most people don't understand about what we talk about when we're talking about, like, hey, the only way this, because somebody was like, oh, we're in deflation. We've been in deflation. I'm like, we've been in inflation for over 100 years. Like it has never stopped and it can't stop. So when I say that statement, and same with Richard Russell's "Inflate or Die," when I quote him or whatever, people are like, what exactly does that mean? So why don't you explain, the government debt and how inflation is basically the only cure for what they have going on here?
So, if you go back to right after World War One, when the British Empire was the dominant empire in the world, it was in its almost in its, you could say, its death days, like the top of the empire, but it was the dominant empire. And at that point, Churchill came out and said, "Hey, we have to really defend the pound, make it strong, so that people believe in us, believe in like." Uh, the value should go to the creditors, not the debtors. And they tried to keep the pound strong versus gold. And what it brought about was huge unemployment, massive deflation, and you had dock worker protests, you had you had protests, strikes, unemployment, and strife almost everywhere. And then as soon as they realized that it just doesn't work, they reversed policy. And worse, what happened was you had this big outflow of gold from Britain to the US at that time. And that was massively inflationary for the US. So that was the only period in history where deflation was tried by a dominant power. And they realized that they just cannot take that medicine. Since then, it's never been tried. So every time an economy goes into debt, so for Britain, it was World War One. For the US today, it is all kinds of wars, starting with the first tariff war. And of course, that's all building on a debt pile that's been accumulated over 250 years. So you have this huge amount of debt. Now, you can technically try deflation, but what does that mean? It means exactly what happened in Japan or what happened in the UK earlier. And that is not a solution anyone is prepared for, because it's always the next election cycle or even the midterm election cycle, and that's the time horizon. So, what do you do with the debt? Well, you can either default on it, and then you go back to emerging market status like Argentina, Brazil, where over a century you just keep defaulting on your debt tens of 10 or 20 times, and then no one trusts your currency anymore. And that's not a good state to be in if you want to have the world's strongest currency or the reserve currency. So what else can you do? Well, you can inflate the debt away. And what does that mean? It just means that you decrease the purchasing power of the dollar so that the future tax revenues, it's easier for those tax revenues to cover the burden on the debt, the interest on the debt, the principal payments, everything. And if you look at, I mean, the Home Alone movies are a classic example. So you go back 30 years, what did you spend at a supermarket for a particular thing? And it's like now it's gone up 10x. And why is that? That's just the dollar getting its value eroded. And that's the way the debt gets the debt burden gets eased. So we don't look at debt in absolute terms, we look at it in terms of debt to GDP. And so you grow the denominator by inflating the currency, and then suddenly the debt looks more manageable. So that's the solution the US is taking, and that's the solution every developed world will always take, with the exception of maybe China. And I think that's why China is going to be very, very interesting over the next decade.
Yeah, no, I agree. I think it's China is probably a place where, I mean, Asia generally is a place where you're going to see a lot more investments in, especially Southeast Asia, I think. So I think that it's spot on, because if you look at the growth of certain countries, whether it's Europe, I mean, Europe's probably already been done for a little while. The growth of the United States, like we're tapping out. A lot of people are like, oh, well, this could continue. I mean, the United States, most dominant defense department, blah, blah, blah. This can go on a lot longer than anybody thinks, or longer than I could even think. So I'm not saying that it's ending today. I am just saying that at a certain point, there will be other countries that are coming up, and these countries will make you a lot more money than just being, wed to US dominance. Now, that doesn't mean there's not places in the United States where you can make money. There always is. But it's just saying, like, the S&P 500 is going to be the leading index for the rest of our lives. Like, that's probably ridiculous. Having a diversified portfolio, especially retirement people, you have a little bit of emerging markets, you have a little bit of, some global bonds. I hate bonds generally, but like global bonds are better than US bonds currently, in my opinion. Short dated at the very least. I wouldn't touch bonds if I didn't have to, but if you have to, that's the way to do it. And looking at like global currencies, and speaking about global currencies, we got the Mexican peso here. And so if we're looking at the Mexican peso, oh, somebody said Thailand looks great. Yep. All right, I'm back. There we go. So now we're going to the Mexican peso. So Kashap, what do you think about the Mexican peso? Do you think it's going to be something that's going to continue to move higher? Do you think Mexico is a place you want to invest in? I do have the Cemex trade still on. I am in that cement stock. Very boring long-term position. Not saying it's got a lot of high beta. It's just a nice position, good stabilizer in the portfolio. So what are you thinking about Mexico, the Mexican peso? What do you find any investments down there? I know you look at a lot of gold miners and mining stocks in that area.
So I do look at specifically mining stocks in Mexico, but the problem has been that the current administration is not isn't it's not I mean, they used to be very hostile, at least in terms of rhetoric, against open pit mines, and now they are not that hostile anymore. They are permitting, but when I look at the opportunities, so with mining, it's a global industry. So when I look at the opportunities and the risk reward, I think I'm better off going further south into Latin America than sticking to Mexico. It's not that Mexico is a bad jurisdiction. I just think that you have better values in Latin America right now. So that is the mining point of view. And if I'm looking at the currency, so it's always a little difficult to see what's going to happen, to forecast what's going to happen to the Canadian dollar and the Mexican peso, and that's just because their biggest trading partner is the US. Now you might think natural resources boom, Canada is going to do well. Silver picks up, Mexico is going to do well, and that could be true. But it's also true that if the US enters a recession, then a lot of manufacturing, a lot of exports from Canada and Mexico to the US get hit. So there's going to be currency impact on that front. So I find these two currencies are really hard to predict. And I would prefer, like, if you are going to play currencies as a commodity story, look at the NOK, the Norwegian krona, look at the Aussie dollar, and forget about the Canadian dollar. And it's the same way if you think there's going to be a global resource boom and it's going to be bullish for all the commodity producing nations. Forget about the Mexican peso. Look at something further south, maybe the Brazilian real, maybe even Argentinian peso, other currencies. So it's just because it's hard to predict, but I mean, if you have a different framework, then I'm sure it works.
Yeah. So, I mean, generally looking at all these, it's just, there's definitely a lot of currencies moving, but speaking about something else that's moving nicely, we've got gold, silver, All right, I'm back. August was a great time to start buying and start looking into some of these things. So, what are you thinking here? You think this has more room to run? Do you think this is slowing down? I don't see anything to say this is going to stop anytime soon. But what are you seeing out there?
So I think it was the last Holy Macro show last Friday where I said gold is ready to begin its move, and the first correction is probably going to be the last entry point after which it's just going to start moving higher. And we got the move higher, we got the first correction, and I don't think there's anything more you need to wait for. It's the time to buy, and this is the first time I've said it's the time to buy since we started talking about this in Jan when gold and silver went parabolic. So I think this is probably as good a chance as you can get to get a good entry into gold and the miners. And I mean, 2 weeks ago would have been great. 1 week ago would have been still good. And now it's kind of, yeah, some things have moved 10-20% to be really get in, but I think this is still the good time to get in because it's the very early stages of the rally. Have I lost you?
I'm kind of here. I don't know what's going on. Gonna give it a second.